we broke our presentation up into 3 different sections. The first one is going to deal with rep and warranty insurance. The second one's going to deal with the subject of fraud. And then the third one's going to deal with just some general trends that we're seeing on some of the more typical provisions that you'll see in an M&A share purchase or acquisition agreement. So to start with rep and warranty insurance, many of you in the room probably have already dealt with it or have seen it or have heard about it. It's not a new subject, but what we're seeing is that it's being used increasingly. And if you ask some people a couple years ago where they thought the rep and warranty insurance market was going, you'd hear a lot of people say that they think that eventually the insurers will stop coverage or that it won't be used as much going forward. But in fact, we're seeing the opposite. So wanted to take a couple minutes just to give the lay of the land of what is rep and warranty insurance. So for some of you that'll be some obvious information, but just sort of set the stage, and then talk about some of the trends we're seeing in terms of how it's being used in transactions. So rep and warranty insurance, as its name suggests, is a policy that can be obtained. It's typically obtained by the buyer, where an insurer will cover the indemnification claims that are made by a buyer under an acquisition agreement. And so this is a very attractive product, particularly for sellers, because it mitigates their exposure to any type of liabilities following the acquisition or their sale. And it's also an attractive product for buyers because the buyers have a certain level of comfort or more degree of comfort with respect to their ability to make a claim under an acquisition agreement. It also allows for a scenario where post-closing they don't need to pursue the seller. So we often see, for example, transactions where the seller, the selling shareholder, will stay on with the company, will continue as management, or will continue in some sort of business relationship with the buyer. And so that makes for a difficult dynamic if post-closing the buyer is seeking to sue the seller because of something that occurred as a result of the acquisition agreement itself. The next slide just sort of gives the stats, which in fact we think is somewhat misleading. I mean, these are just based on market studies. It does show the trend that we're speaking of, which is that the use of rep and warranty insurance has nearly doubled from deals that were canvassed in 2016 and 2017. For one thing, we think that rep and warranty insurance is actually being used a lot more. Just because an agreement doesn't reference rep and warranty insurance doesn't necessarily mean that that hasn't been used in the context of that transaction.
I think it's when rep and warranty insurance first started being used, it was so novel that parties felt the need in the agreement to mention the fact that there was a policy, to have provision saying the purchaser will rely on it, to confirm that they're procuring a policy. As it's become more and more common and people understand how it works, we're just not seeing it mentioned in the purchase agreement because it's technically not relevant to the actual purchase agreement. There are features in a rep and warranty deal that you'll see reflected in a purchase agreement, like very low or no indemnification escrow, low cap with no mention of recourse back to the sellers for anything in excess of the cap for fundamental reps, for example. But the policy itself doesn't really have to be mentioned in the agreement. So I think when you look at deal studies and see that, in 48% of the agreements that were looked at, it's not referenced, doesn't mean there's no rep and warranty insurance in those deals. We actually find that particularly in deals involving private equity buyers, probably 90% of them have rep and warranty insurance these days.
Yeah, and to top up on that, where you're seeing it almost all the time is in a competitive auction process. So where there's an attractive asset that has many bidders, it's almost a price of admission now for a potential buyer in that process to offer up a transaction where there's going to be rep and warranty insurance, which mitigates the exposure for the seller going forward.
Our advice to buyers used to be getting rep and warranty insurance is a really good way to differentiate yourself from other bidders and make your bid look more attractive. And today, the advice is, usually we don't have to give the advice because sellers in their process letters leading up to an auction will say, we expect all bidders to have rep and warranty insurance. So it's sort of a prerequisite to even bid. But even where a process letter doesn't say that, our advice to clients is Not that you'll look great if you have rep and warranty insurance, but more like if you don't, you'll stand out in a negative way because every other bidder probably will. And I think it's even at the point now in non-auction situations when buyers are just trying to make an attractive offer to a seller, even when they're not in a competitive process. It's very common to see rep and warranty insurance at least discussed. Because a purchaser just knows sellers are aware that it's in the market. They almost expect it. They'll certainly expect a very low escrow, unlike what we would have seen 5 years ago, where 10% was a very standard indemnity escrow. Now sellers know that 1 or 2% is more market. And so it just pushes buyers towards thinking about rep and warranty insurance right from the beginning.
And we should also mention that in the vast majority of cases, rep and warranty insurance is usually acquired by the buyer, so it's a buy-side policy. And the stat on this page reinforces that. Seller-side policies do exist. We seldom see them. There could potentially be as a negotiated agreement where the buyer and seller will split the costs of a rep and warranty insurance policy, or will split the deductibles that may result, in the event that a claim is made. But we typically see buy-side policies, meaning that the buyer is the one who engages the insurer, and if there is a claim made under the agreement, the buyer goes directly to the insurer. Rep and warranty insurance doesn't necessarily work for all transactions. In a couple slides, we'll talk about some of the features of a transaction that are more appealing for rep and warranty insurance coverage. But one thing we wanted to note, and the market studies confirm this, is that certain industries, rep and warranty insurance doesn't work as well in an acquisition. So, for example, any target that has exposure to a lot of environmental liabilities. Typically, rep and warranty insurance won't really bridge the gap that you normally see at bridge because insurers often exclude from their coverage environmental liabilities. And so the acquisition of or the procurement of a rep and warranty insurance policy will not take care of that issue. Also in life sciences, we see that rep and warranty insurance is used less because of the nature of some of the liabilities that could come up post-closing on a life sciences target are often excluded from a rep and warranty insurance policy. And generally, what we see right off the bat is that product warranty or recalls are rarely covered by an insurance policy. They're often excluded as a general practice. And so those often don't end up being a good option for industries where that's an issue. So the type of transactions for which rep and warranty insurance works well is when you start getting to an enterprise value that exceeds $50 million. And the reason for that is the economics. It still costs money, obviously, to procure rep and warranty insurance. The typical premium is somewhere around 2% of the coverage that's being obtained under the policy. And so the lower you are in transaction value, the less the economics make sense to actually pick up a rep and warranty insurance policy.
A typical cap in a non-rep and warranty insurance deal is probably 15% or 20% of purchase price. So in a $20 million transaction, if your cap is going to be $2 million anyway, most acquirers will just self-insure and say, well, we'll take the risk, and it's not really worth it for us to pay a premium to insure a $2 million risk. So for that reason, smaller transactions, I won't say never have rep and warranty insurance, but much more rare. 50 million is usually the number where we start to talk about it more seriously.
But even then, to show the trends that are taking place within the market is that 2-3 years ago, even a $50 million deal, I think, was one that was looked at as not suitable for a rep and warranty insurance transaction, and is becoming increasingly so because this is a very profitable product for insurers. It's been going really well for them. And so it's become much more competitive within the insurance market. And so you have a lot of insurers that are trying to tap into those lower transaction values in order to just increase the coverages that they bind.
Yeah, it's still, we're kind of jumping ahead a few bullet points, but it's still the larger the transaction value, the higher the likelihood that there will be rep and warranty insurance, but the minimum number at which buyers start to look at it has dropped pretty steadily over the last 3 years.
And so as we mentioned, I mean, one of the benefits of rep and warranty insurance, it obviously facilitates, at least in theory, the negotiation of the transaction agreement. On a non-rep and warranty insurance transaction, as I'm sure many of you in the room have experienced, negotiating the reps could be an arduous process. A lot of that theoretically goes away when you have a rep and warranty insurance transaction, because what the buyer will say to the seller, and which the seller in principle should accept as a position, is that, well, it's not you that we have recourse against, it's the insurer. And so, you know, we'd like you to give us a broader set of reps and warranties. And so the seller sort of then looks at the package of reps that they give in a bit of a different light. They don't look at it in terms of the exposure that they have to liability, but rather they don't want to give reps that, for example, will have overly burdensome disclosure obligations. Or, of course, they won't want to give any reps that they can't give because they know that they're not able to give it, or because they have absolutely no ability to really diligence the provision of that rep, because that could give rise to potential fraud claims. But other than that, the general sense is that because it's insured, the sellers are expected to give a broader package of reps and warranties.
Yeah, if you've negotiated reps and warranties in an agreement, you know one of the biggest points of debate is knowledge qualifiers. Sellers want a lot of them, and they say, well, there's stuff here we can't possibly know, so we want to knowledge qualify it, and the buyer's response is, well, you don't know, but we don't know, so it's really just risk allocation, and that could become very contentious on some points. But when there's rep and warranty insurance behind the indemnification obligations, it's much easier to convince a seller you should take the risk, because the risk ultimately falls on the insurer, not the seller. So it usually cuts negotiation time on reps and warranties anyway significantly.
And on the indemnification provisions as well, in terms of, for example, you know, the deductibles, the caps, the you know, mini baskets, things like that. A lot of that tends to go away when you have a rep and warranty insurance transaction. Other transactions where it's suitable, as we mentioned, you know, situations where the buyer does not want to enter into doesn't want to have a scenario where they are making a claim against a friendly seller, one that's going to stay on as management or have a business relationship going forward. If the buyer's concerned with its ability to recover from the seller post-closing, so in a distressed M&A transaction, or if the seller is a PE fund that's at the end of their fund life, those are circumstances where insurance becomes particularly attractive.
Those last two bullets tie together with respect to PE funds. So where you have a private equity seller, you will 100% of the time have rep and warranty insurance. Firstly, because the way private equity firms work is they sell, they take the proceeds of sale, they distribute them up to their limited partners. The last thing they want to have to do is 8 months later go back to their partners and say, we have to claw back some of those proceeds because there's been a claim. And a lot of funds distribute their proceeds and then they wind up because it's the end of their fund, and that's why they're selling. So there isn't even an agreement in force anymore after, you know, pursuant to which they can go back to their LPs. So as sellers, PE firms will always want rep and warranty insurance. As buyers, again, the typical structure for a private equity deal is you buy 80% in cash and 20% in equity that you give to the sellers, who are the managers of the business, and you rely on them to run the business going forward and to help grow it together. And the last thing they want to be doing is suing their managers for a breach of a rep and warranty, because that could understandably cause some friction with their seller that's now their partner. And we used to see, you know, a lot of instances pre-rep and warranty insurance where our clients would call us and say, you know, we have $1 million claim. We want to reserve our rights, but we don't really even want to send the notice to the seller at this point because it's highly unlikely we would go after them for $1 million. It's just not worth it to, you know, to sever the relationship or harm the relationship to make a claim that's not, you know, it's important but not overly material. Rep and warranty insurance sort of does away with all that. You don't have to worry about, making your seller angry because at the end of the day, they're not paying.
So on the next slide, just to give a bit of data on costs of the policies or claims that are made thereunder. So as mentioned, a typical North American premium, the cost to procure the insurance had historically been about 2 to 4% of the coverage that's provided under the policy. We're seeing more and more because it's becoming increasingly competitive, and also because the insurers now have prior years to look at in terms of seeing how many claims are made or how profitable the market is more about 1.5% of a transaction value. So that's the cost to procure it. In addition to that cost, you'll have a non-refundable underwriting fee. In the process, when you get rep and warranty insurance, the insurer does their own diligence, because almost like a buyer, they know that they will be on the hook if there's a breach of a rep and warranty. So they don't just blindly cover that. They actually engage in their own diligence process. So the underwriting fee covers their engagement of their own legal counsel, who will have access to the data room, who will receive copies of all the due diligence reports that are produced for the buyer, and will assess the risk of potential claims post-closing. And the moment that there is a known risk, so if, for example, the buyer's law firm produces a diligence report and it's super clear in that report that there is a risk for some sort of pre-closing employment liabilities or pension liabilities, that'll be a signal to the insurer that they'll exclude that from the coverage, because they will not cover known risks. So
we've done work, typically we're acting for a buyer or seller, but we have been engaged by some of the rep and warranty insurers in transactions in which we're not otherwise involved to represent them. And I think the first time we were engaged by insurers, we thought this is going to be a really diligence-heavy mandate, where they're going to want to look at everything and understand every risk and really get into diligence at least as much as a typical buyer, but maybe even more, because they don't have the same motivation to just get a deal done that a buyer does. But we were surprised to find out that they actually don't go that deep into the diligence. We'll look at the purchaser's law firm's diligence report, as Jeremy said, just to note any sort of known risks that we want to carve out of the policy. But other than that, really all the rep and warranty insurers want to know is that the buyer has done a very thorough, fulsome diligence that it would do in a normal transaction. And once they get comfortable that the buyer did its diligence, they don't seem to care much about having us doing supplemental diligence. They know that the reps and warranties in the agreements are broader than what you'd see in a non-rep and warranty deal. And we've made comments to them saying, just note this rep is really broad, way more purchaser friendly than market. And, we pointed that out to them on a number of reps, and they really don't care. They understand their broader reps. They understand that we are not doing supplemental diligence on top of what the buyer does. They seem to be making enough money just pumping these deals out, knowing that buyers have done a pretty good job on diligence. That seems to be all they're looking for. So that was probably the most surprising thing to us that we saw when representing rep and warranty insurers, but that seems to have remained their approach. And premiums have actually been dropping. Their budget, their caps on what they pay their lawyers to represent them seem to be dropping, which indicates they want even less and less review and diligence. They really just want to insure deals, and with very little regard for what the reps say.
And if we look at the data on claims paid, so because I think it all ties into that there's increased competition within the market. So for example, as Warren was saying, the sort of less diligent due diligence process by the insurers could also probably be attributed in part to the fact that if they're going to be too diligent, that they wouldn't be an attractive insurer on the market. There also, because of the increased competition, there's an increased pressure to pay. So obviously, an insurance policy isn't worth much if at the end of the day, when you actually try and make a claim, the insurer finds a reason why it shouldn't pay it. And so you're seeing increased comfort from buyers that when they actually do have to make a claim, the insurer is going to actually make it.
Not to create the impression that it's easy that you just submit your documents and make a claim. So we've been through a few claim processes, and like every insurance product, they don't make money by paying. They know they have to, but they negotiate heavily. Not so much whether there's been a breach. I've actually never seen a case where an insurer has disputed whether there was actually a breach, but they'll fight pretty hard on determination of damages. Never seen one of these go through a litigation. They always get settled, but I can tell you the delta between the initial claim in terms of amount of damages and the insurer's initial position on what damage should be is very, very, very large. And we usually find a middle ground, usually more towards what the insurer wants to pay. But they are paying, I have seen $17 million payments made, which is painful for the insurer, and they fight it, but they make them.
And in fact, the average claim payment in 2018 was $19 million. And I think that's an average. So again, if we work on the premise that the very large transactions are likely to have rep and warranty insurance, obviously the larger the deal, the larger the potential claims for damages for any breaches, which I think is why that's high. So the next slide, I think we've gone through most of this already, so we won't go through each bullet, but the point that we want to make here is that obviously when rep and warranty insurance is being used, that impacts the agreement. And it impacts not only the reps and warranties and the indemnity provisions, but ends up also sort of bleeding into other provisions and risk allocation generally between buyer and seller. So, as we said, in some instances that helps the buyer, so you'll get a broader set of reps. You'll typically have a double materiality scrape in a rep and warranty insurance transaction, whereas when it's non-insured, that becomes more of a negotiation point. And on the seller side, you see some more seller favorable provisions when you have a rep and warranty insurance transaction, such as obviously a lower escrow, no express set-off rights, because the whole point is the seller wants to limit their exposure in the transaction. And less likely for there to be a pro-sandbagging clause in a rep and warranty insurance transaction. So the next slide, which is how we'll conclude on this section, is just to sort of bring it all together and talk about the trends that we've seen since rep and warranty insurance had been instituted on the market.
Yeah, so pre-rep and warranty insurance, so let's say 6-7 years ago, your typical, if you were going to say what's market for escrows and deductibles and caps, you would say 10% escrow, that was almost automatic. Deductible would be 0.5% to 1% of purchase price was automatic. Your only debate would be where in that range do you fall. And caps for non-core reps and warranties, 15 to 25% of the purchase price. And that went down over time. Probably 15 years ago, the typical cap was 50%. The US trend was to go much lower, and we sort of followed that trend. So we'll say it was 15 to 25% pre-rep and warranty insurance. When rep and warranty insurance started to become a popular product, the way the escrow and deductible worked was you would have your retention amount under the policy, which is the word that insurers use for deductible. So you'd have your deductible under the insurance policy was the starting point. And then you would typically say buyer and seller are going to share that retention amount, so half each. So the first half of that retention amount will be a deductible. So that's essentially on buyer's dime because they have no claim for that 0.5%. The next half would be on the seller's dime through an escrow, and that would be a sole recourse escrow. So if you had $1 million deductible under your policy, you'd have a $500,000 deductible in the agreement, and then a $500,000 seller escrow, and then the policy would kick in. For non-core reps and warranties, you would then typically have recourse back to the seller. So your policy is going to have a limit, and it's whatever coverage you want to buy. Let's say, I think a typical number, buyers usually buy 20 to 25% purchase price will be their policy limit under the insurance policy. And if there's a breach of a core rep, they could go back to sellers, and even sometimes for non-core reps in excess of the policy, they could go back to sellers. So that's how rep and warranty insurance sort of started. The current trend that we're seeing, and this is, I would say, the trend in the US and increasingly becoming the trend in Canada, is absolutely no escrow, which is, again, something, if you had told us that 3 years ago, I think the reaction would have been, it'll never happen. And the thinking was that the insurer wanted to make sure that the sellers had some skin in the game, even if it's a small escrow, that they had some exposure, because that's how insurers got comfort that the sellers read the reps and warranties, made appropriate disclosures, spent a lot of time on their schedules, made sure to help the purchaser do a good job in diligence, because they had something at risk. These days, we're seeing no escrow, so just what we're calling complete walkaway deals for sellers. And we find that that has affected the pricing of the policy. The premiums are a little bit higher when there's no escrow, but almost an insignificant amount. So I don't think it would deter a buyer from having a no escrow deal just based on the increased amount of the premium. And the other thing we're seeing is no recourse back to the sellers to the extent that the damages exceed the cap. We're seeing that certainly for non-core reps. It's just sole recourse to the policy and that's it. And more we're seeing it for core reps also, meaning the most fundamental of reps could have been breached, such as ownership of shares. So turns out the sellers didn't even really own the shares with no liens, and there's still no recourse back to the sellers for that. So obviously very, very favorable seller formulation, but mostly because, I mean, it's all about the market, and buyers are feeling the need to offer that to sellers to make their deals look more and more attractive. And because some insurers are willing to live with it, other insurers have to jump on board also, or else they'll lose out on their market share. So I would say in a year from now, the most common structure is going to be absolutely no recourse back to the sellers post-closing at all. So what we, in private deals, we refer to this as public deal indemnity structures. So I think that's where we're headed in the market.
So that wraps up the section on rep and warranty insurance. As one last point on insurance, because I think it's a nice transition into the next section, which is fraud, is that under a rep and warranty insurance transaction, the principle is that you are limiting or eliminating the seller's exposure to liability. As a seller, what they care about when they review a rep and warranty insurance policy, the only thing they really care about is to make sure that there's no subrogation right for the insurer to then go ahead and sue the seller. So if the buyer makes a claim because there was a breach of a rep and warranty, and then the insurer tries to subrogate into the rights of the buyer and go pursue the seller, that would obviously defeat the purpose. And so that's the one thing that a seller will look for when they're reviewing a policy. The exception always to that is if the seller committed fraud. So if a seller commits fraud and that results in a buyer claim, then the insurer is permitted to go after the seller.
I'll just on that point note that, we said that often in share purchase agreements, there's no need to mention the rep and warranty policy. I think the one exception to that, what we like to see as a seller, is a covenant by the purchaser that it won't amend the rep and warranty insurance policy. As the seller, you're obviously not a party to the policy, and the most important thing you care about is making sure that the insurer doesn't have subrogation rights, except in the case of fraud. So a provision that we, when we're acting for sellers, like to put in a purchase agreement, again, as a covenant by the purchaser that says it will procure a rep and warranty policy that doesn't allow for any subrogation rights, except in the case of fraud, and that the buyer can amend that policy without the seller's consent. And fraud for this purpose will be specifically defined in the agreement and in the insurance policy for reasons that come up in the next part of our presentation.
Yep. So oftentimes you'll see generally in a share purchase agreement or an asset acquisition agreement that the word fraud is mentioned sometimes. And often where it's mentioned is it serves as an exception to the negotiated indemnification provisions. So for example, you'll have in your indemnity section, there'll be a cap that says that the buyer's entitlement to make an indemnity claim under the agreement is subject to a maximum amount, except in the case of fraud. And that's also, for example, when you have a non-reliance clause, which says that the buyer acknowledges that it's relying on nothing but the representations and warranties that are actually provided in the four corners of the contract, you'll typically have an exception, but for in the case of fraud. So that seemed to be, it had been customary for a very, very long time, and people didn't really put a lot of focus on that because it seemed like a fair thing to say, that, you know, the cap shouldn't apply if the seller actually committed fraud. What we're seeing more of now is fraud being defined within an agreement, and the use of fraud in the agreement is being looked at very carefully.
So everything about fraud changed about, I'd say, maybe 8 to 10 years ago when a lawyer in Dallas named Glenn West wrote an article, and it's a Texas law article, but has made the rounds through the legal community talking about fraud and saying, you know, what does fraud really mean? And that it may not mean what we think it is. So a very, you know, every agreement used to have a carve out for fraud. Everything's off the table in the case of fraud. And he noted that when we say that and when a seller agrees to that, a seller is probably thinking about fraud as we think about it, which is you very purposely done something consciously to deceive the other party to the agreement. And the point that he made in this article is, well, fraud may end up being defined much more broadly than that by a court. There's things such as unintentional fraud, which seems like, you know, a contradiction because that's not how we think of fraud. Negligent fraud. He didn't have any specific case law that said, here's the case that says there's an issue, but it certainly raised a concern, I think, in the market that carve-outs for fraud may be much more broad than we think. And there have been some updates to that article based on case law that's come out since it was written that are covered later in our presentation, but that was a very that was sort of a turning point with respect to fraud in the market and the way lawyers thinking about it when drafting contracts, because all of a sudden it became very dangerous just to have a carve out for fraud without defining what fraud means.
Yeah, and to be clear, this is a seller issue. And the reason it's a seller issue, one of the things that came out of that article, and that has now been confirmed by case law, is that, and we also know that that's the case not only for Delaware or the US, but even just under Quebec civil law, for example, even if you say nothing about fraud in your agreement, under law, you know, if there was fraud actually committed, so again, that very egregious, intentional, fraudulent, you know, action by a seller, a buyer would have recourse to court, irrespective of what the contract says. So the moment you introduce fraud into your agreement, it becomes a seller issue because that could impact how the courts are going to look at fraud in that instance. So one of the points that we want to make, we can actually skip through a few of the slides here, but is that fraud under law is a court will look at fraud as something very intentional, a conscious action by the seller, a very egregious act. If you introduce fraud into the contract without setting appropriate parameters around it, then what you actually do is you could potentially be inviting the court to apply a standard of fraud that is broader than what would otherwise be applied just based on the law itself. The other thing is, as mentioned before, you know, we carefully negotiate a contract as buyer and seller. Seller wants to be very clear on what are its indemnification obligations in the event that there is a claim post-close, what are the caps to that indemnification, what are the baskets, things of that nature. And also, you know, what seller, if you have a multi-seller transaction, so you have a number of sellers that are shareholders of the target company that are selling their shares, is one seller responsible for the actions of the other? These are all points that are very carefully negotiated. Fraud sort of turns that all on its head unless you properly define fraud or unless you just rely on fraud under law.
Like a typical provision in agreement 5 years ago, let's say we're talking about a cap, would have said, the cap on indemnification is 20% of purchase price, except in the case of fraud. And people just sort of accepted, like, yeah, that makes sense. Fraud is the exception. I think today, in a multi-vendor scenario, that provision would say the cap is 20% except in the case of fraud, and it would be capital F fraud that would be defined as an intentional, conscious deception. And it would also say, except in the case of fraud, in which case only the cap would cease to apply, but only to the vendor that committed the fraud. So you'd also be worried about whose fraud is relevant, and the fact that one vendor was fraudulent shouldn't affect the cap that applies to some other vendor. So we didn't really think about all these things until this magical article came out and everyone started really concentrating on fraud and what does it mean. But your standard provision today looks very different than what it did 5 years ago, just based on how people think about fraud.
And a recent case that came out in Delaware that had a lot of people's attention this is particularly relevant for private equity sellers. For all the reasons we've already covered, private equity seller wants certainty in their deal. They also want to know that their exposure to liability after the deal is limited or eliminated altogether, because once they receive the proceeds from the transaction, they're going to distribute that to their LPs, and they don't want to be pursued after the fact.
Yeah, and they'll usually, what we talked about earlier, when they buy a company, they keep management on to run the company, and it's management that's involved in the day-to-day operations, and the private equity firm is not. So if there's fraud in any of the reps and warranties, almost just by definition can't be the private equity firm that committed the fraud, because they don't really know enough to be fraudulent. If anyone's going to be fraudulent in giving reps and warranties, it's going to be the managers that have a small piece of the company going forward. And so it's important for the private equity seller to make sure that the fraud committed by one of these managers in giving reps and warranties doesn't affect any of the limitations on liability that apply to the private equity seller.
And that's exactly what that Delaware case brought to the fore. So you had a private equity seller who there was a claim for fraud made by the buyer, and the allegation of fraud was really because someone from management was fraudulent in terms of how the reps and warranties were given. But because the transaction agreement just had this sort of general carve-out, but for the case of fraud, or except for in the case of claims that involve fraud, the court actually ended up interpreting that as saying, well, now all bets are off, and the buyer could go after all sellers for the full amount or even more than the full amount of the purchase price. And so a private equity firm who had no participation in the fraud at all, had no knowledge on operations, ended up being subjected to significant liability as a result of that case. And we started seeing that a few years ago, I'd say, where private equity firms or venture capital firms were particularly focused on that, so that even in the section on reps and warranties, they didn't want to be that the sellers were giving reps and warranties on the company. They would, for example, want the company to be a party to the agreement, the target company to be a party to the agreement to give those reps. And then in the indemnity section, you would say, which sellers could you pursue if the company had breached a rep. And the purpose of that was also along the same, with the same philosophy that a private equity firm or venture cap firm would say, I can't give these reps even because I know nothing about the operations of the business. So I shouldn't even be in the contract repping to anything company related. The next slide just shows, both in Quebec and common law, again, if you don't open up the broader contractual approach to fraud and you just rely on what a court will say based on law, there's sort of this sense of gross or intentional fault, it's only the vendor itself who committed the fraud that should be responsible for the fraud claim. And there also needs to be even an element of proving that the buyer relied on that fraudulent representation in terms of entering into the agreement. And so if you just use a loose reference to fraud in your contract, you actually don't get to benefit from what are already pre-existing parameters under law for how fraud is interpreted.
I think that the conclusion is the best approach, certainly for a seller, is just be silent on fraud. And typically you can get your buyer comfortable with that on the basis that if there's actually been fraud, a buyer will be able to go to court and the court won't respect the contractual limitations. Fraud is fraud. And as a seller, good luck arguing that, yes, I committed fraud, but the agreement says only the reps and warranties matter. Not likely to be a very successful argument, and most buyers will get comfortable with that. The issue is, and why fraud is still discussed so much, is because in the rep and warranty insurance universe, there's subrogation in the case of fraud. You almost have to get into fraud and what fraud means and how it's defined and what the carve-outs are. We always make sure as a seller that fraud is defined in the policy. And that's part of the provisions that we don't want a purchaser to be allowed to amend, because we want to make sure that subrogation rights only apply where we've intentionally tried to deceive someone. But that ends up flowing through a little bit into the purchase agreement also, because the buyer will want fraud carve-outs there, and you'll want everything to match with the policy. So I think the approach is in a non-rep and warranty insurance deal, remain silent on fraud. It's a little bit tougher in a rep and warranty insurance deal, but there you want to just make sure you have a good, narrow definition of fraud that matches what fraud means under Quebec law and a Quebec agreement.
Yeah, and so, if you try and be silent on it, a buyer will usually say, well, what do you mean? You're not comfortable carving out fraud? And of course, the seller would say, well, you got it anyways under law, but oftentimes, just philosophically, the buyer will want to push for that. And as such, as Warren said, defining fraud, which is becoming increasingly more market practice, is the way to go. And so we have one slide here, and we can conclude on this for this section, where we just give a sample definition of fraud. Yeah. So, a typical formulation that's particularly vendor-friendly, but fraud means an actual intentional fraud with respect to the making of any representation or warranty set forth in this agreement, with the intent to deceive another party hereto, and to induce that party to enter into this agreement or any other agreement or instrument to be executed by such party, and requires knowledge or belief that such representation was false when made. So with that definition, you're at least very clear as to what is fraud, and because that opens up a whole lot of other stuff. So on our final section, just wanted to go through certain M&A trends. Every year or two, deal studies come out, which canvass publicly available acquisition agreements in order to determine what is market. You often hear in negotiations a buyer or seller saying, well, this is off market, and sometimes they'll even reference deal studies. We are always reluctant to do so. The deal studies are informative, but for one thing, they're not a perfect representation of the way deals are actually conducted, because again, they're based on a sampling of publicly available agreements, and which means that they're inherently, usually by public companies that are acquiring private companies and are obligated to publicly disclose that information or that contract, and that's obviously a certain subtype of transaction, or one that has different transaction values or things of that nature. So, but it is informative to kind of see, the trends and where things are moving. For example, as we were mentioning in a prior slide, caps, used to be something like 50% of the purchase price. And now, as the deal study shown, as our own experience shows, caps are closer to 10 or even lower. And so it's always good to look at these studies, and we thought it would be helpful to just look at some of these recent trends and use that as an opportunity also to speak of certain provisions that appear in an acquisition agreement.
Yeah, I think the one, just because we're limited in time, that we'll skip ahead to, that's the most to talk about. A lot of these are just numbers that, percentages that may not be useful when you're actually negotiating an agreement. But one that raises a lot of issues is earnouts. Earnouts are becoming more and more prevalent. According to these slides and these public deals, we see them in about 27, around 25 to 30% of transactions. In private transactions, we're seeing them more and more, probably I would say even over 50% in the last year. An earnout, of course, being payments made after closing, additional purchase price paid to sellers based on the performance of the company post-closing. The market, the way it is today, I mean, the biggest obstacle to getting transactions done is the different expectations that buyers and sellers have in terms of valuation. And buyers want to pay a certain price. Sellers all seem to think their company's worth much more and is trending upwards, and their multiple should be applied to a higher amount of EBITDA or revenue than what the buyer's using. And so one very effective way to bridge that gap is through an earnout, where a buyer agrees we'll pay you X dollars at closing, and then if the company hits certain milestones after closing, we'll make additional payments of purchase price to you. So in theory, very simple, very straightforward. The issue is always operational control of the company after closing. From the buyer's point of view, it bought the company. It's usually paid most of the purchase price at closing because the earnout payments are typically much smaller than the closing date payment. And so it should have and deserves the flexibility to operate the company as it sees fit. From a seller's perspective, the seller will always argue, you're paying us less than what the company's actually worth. We're confident that if we were still running the company, we would hit these earnout targets and we would earn the earnout in full. And therefore, we need to have some right to manage the company as well. Because if you, the purchaser, take it and start managing it and operating it completely different than we did, and then we miss the earnout targets, well, that's unfair. You've deprived us of the rest of the purchase price that we would have earned had you paid us the right amount at closing. And so typically a purchaser draft of the agreement will have no earnout covenants, nothing about operation of the business after closing, just, if anything, an acknowledgement that the purchaser owns the business and has the right to operate it as it sees fit. And then a seller's typical first draft will have pages sometimes of earnout covenants about what the buyer can do, can't do. Sometimes it's just one sentence that says the buyer covenants to do everything in its control to maximize the earnout payment. And as a buyer, your reaction is always going to be, there's no way we can agree to this. The primary reason is if you have earnout covenants, any sort of promise to operate the business in a way to maximize the earnout or to not take actions outside the ordinary course of business, at the end of your earnout period, if the earnout target isn't met, you will almost certainly have your sellers look for some reason to make a claim. Find something you did, some decision you made, and say you've breached your covenant to maximize our earnout or to operate the business in the ordinary course, and we're suing you. So buyers are, obviously afraid of this result, and so they resist earnout covenants at all costs. One thing we see often, and this is an agreed upon sort of middle ground, is a buyer will agree to say it will operate the business. Sometimes they'll agree to say in good faith and in a commercially reasonable manner, although that opens a door to litigation a bit also. But they'll usually agree to say we'll not take any action with the sole intent and purpose to avoid achievement of the earnout. Another formulation is with the primary intention of avoiding achievement of the earnout. It's all the back and forth trying to find the middle ground between making a seller comfortable. What a seller's worried about, or what it should really be worried about, is things like purchaser diverting revenues from this company to one of its other companies. The purchaser, if the purchaser was just buying this business as a standalone and had no other businesses, you don't really have concerns as a seller. Everybody's interests are aligned. The purchaser wants to maximize the value of the company even more than the sellers do because it owns more of it. So you don't have, there's a complete alignment of interests. But typically purchasers don't just own one entity after the transaction. They have other businesses as well. And so what sellers are worried about is that, again, you divert revenues from this entity to some other entity. So for the purchaser, it's just taking out of one pocket and putting in the other. There's no detriment to the purchaser, but what you're doing is depriving the seller of its opportunity to earn its earnout. So a covenant like this gives the seller comfort that the purchaser won't do that, and also gives purchaser the comfort that it can take commercially reasonable decisions it needs to and run the business the way it thinks it needs to maximize profit without being in breach of its earnout covenants. So that's a nice middle ground.
And I would add to that, you know, as Warren said, this becomes more of an issue if a purchaser has a group of companies and the target now fits within that group. But even sometimes that can come up even as a standalone company, depending on what your earnout metric is. So if, for example, earnout is based on EBITDA, so, you know, the buyer may not necessarily in the near term after closing want to just work to maximize EBITDA. In principle, it probably does, but it may have longer term vision for the company. It may want to introduce new costs for marketing or growth, all of which would impact the bottom line. And so in those instances, you can also have this issue where there's a misalignment of what the buyer wants to do post-close, even if ultimately they have their eye on long-term value, versus the seller who has an earnout that says EBITDA must hit this threshold, you know, in the year following closing.
Another huge issue that comes up in the context of earnouts often is that, just practically speaking, as the buyer, you can't make certain payments at certain times under your existing credit facility. So, for example, you'll have financial covenants in your credit agreement, and without lender consent, if you're violating your financial covenants or close to violating your financial covenants, you can't have cash leave the company. So, you know, if you have an earnout that's payable even in just a year from now, as a buyer, you're never completely sure that in a year from now you'll be able to make that payment under your credit agreement. And as a buyer, you don't want to be in a position where a year later, you know, the earnout is payable, and so you have a contractual obligation to pay the earnout, but you also have a covenant in your credit agreement not to make the payment because you'll be offsides your financial ratio. So a purchaser will want to put something in the purchase agreement, in the earnout provision, saying, we will make this payment provided that we're not prohibited from doing so under our agreements with our lenders. When sellers see that, they understandably have a negative reaction because in their view, we have an agreement, we've earned payments, we've hit the earnout targets, we've done our part. How can we agree to something that then says, well, maybe you don't have to pay us because you're having issues with your business elsewhere, not related to this. In a private equity context and in the case of a lot of strategic buyers as well, the answer is just simply, we have no choice, that there's nothing we can do about it. And it ends up being often a very contentious issue, but purchasers, in many cases, literally have no choice but to do it. So after much discussion, they usually get their sellers comfortable that especially in a scenario where the company, this new company is a big part of the operation, to say, look, if you're hitting your EBITDA targets, it should mean that there's sufficient cash flow and we wouldn't have an issue under our credit agreement. We'll be able to make the payment, but we still need to put this provision in there just in case. And in some cases, they're actually in breach of their credit agreement simply by not putting a provision in a purchase agreement that says payment is subject to lender consent or compliance with financial covenants. So I've had more deals than I could count where the last issue outstanding was this one, and everyone just sort of punts it, and a buyer's position is usually, or their view is usually, when we get everything else settled and we're ready to close, and the only thing standing between the vendor, you know, today and the vendor getting paid, it's $30 million, is them agreeing to this covenant, they'll agree to it. And they're almost always right. And it ends up, you know, we end up getting this caveat in the purchase agreement that we want, but it's one that when we're negotiating LOIs for clients or commenting on LOIs, we try to put something in the LOI as early as possible to say this, and it's because find at the LOI stage, people are less detailed. They're more focusing on purchase price and sort of bigger picture items, and this one kind of slides by. And it's much easier when you're drafting your purchase agreement to say, well, look, this was in the LOI, so it should not be a surprise. So it's a good idea if you need a provision like that to be thinking about it at the LOI stage and try to get it out of the way as soon as possible, because it often becomes a very contentious issue.
And then I think we just have a couple minutes left. So, one thing that's interesting coming out of the studies sometimes, or out of just our own experience in transactions, is you start to see, new elements added to reps and warranties that are aligned with things that we're reading about in the news as being more prevalent. So, for example, the Me Too clause or rep that you wouldn't have seen at all 5 years ago is now being pushed more often, relating to the buyer getting some sort of representation from the seller that there's no issues of sexual allegation at the company, which obviously could open up a lot of reputational risk and monetary liability as well. Cybersecurity and privacy, obviously, we're seeing a ton more of that. It's almost become standard for any company that's involved online in any manner, or that has access and stores data, personal data of customers. The other sort of points, the key takeaways, I think that we can just sort of sum it all up and then open it up to some questions. So again, continued use of rep and warranty insurance, it's becoming an increasing trend. We don't see it going anywhere, especially in this very, very seller-friendly market, and one in which the insurers are willing to provide insurance at good pricing. Another takeaway, think about the use of fraud in your agreement. The moment you see the word fraud in your agreement, that should signal to you that there needs to be more thought probably put into it, because the old formulation was simply, this general exception for fraud. And then the third point, market trends, earnouts continue to be very prevalent because of the frothy valuations that are out there. One point we want to make generally, if it comes up in your negotiations, is you often hear people talk about what's market or deal studies, and they'll cite the US example. And oftentimes Canada is behind the US in terms of catching up to trends. So we look to the US a lot because that sort of is an indication to us as to where we think the Canadian market is going. But the Canadian market tends to be a year or two behind in terms of catching on to a lot of these trends.
Yeah, I'd also caution against using the public. It seems like the ABA deal studies is something everybody has and looks at. Just keep in mind that the scope of the agreements that go into those studies are very limited. Again, it's public deals. The Canadian one has gotten a little better over time, but those used to be heavily focused on oil and gas deals that were actually completely different kind of market than what we see in private M&A. So the deal studies are interesting to see trends, but typically not a great tool to sit down with in a negotiation and say, well, the deal study says so-and-so is market, because I think our experience in private deals, especially with cross-border components, is very different. And what the market trends happen to be in the US become the market trends in Canada within 6 to 8 months. So just be wary of using market studies for negotiating purposes.
With that, we open it up to any questions.
Yes. If you can give some precision as to the difference of fraud in the Quebec law versus the common law.
Yeah, well, I think that generally speaking, they're actually quite similar. They have an element of intentionality, an element of reliance, so the buyer has to have relied on that fraudulent claim.
One difference seems to be there's a lot more emphasis in the common law on the fact that the buyer actually relied on the fraud, whereas opposed to in Quebec, it's more, have you dealt fairly? Have you acted in good faith? Ultimately, You know, I think while the principles may in theory be different, I think at the end of the day, the result's going to be the same. A court is going to look at, did you do something intentionally? Did you do it to try to deceive? I think buyer reliance on that would have to be important, because I think if you're a buyer in Quebec alleging fraud and you prove that someone acted intentionally, but you didn't actually rely on it, you know, I think you would look at the analysis of, okay, what are your damages resulting from the fraud? Well, okay, you've proven fraud, but what are the damages if you didn't rely on it? So I think ultimately it's the same. The words may be different and we may get there through a different analysis, but I think it's the same. I think you've proven a very high bar and that you've relied on it to your detriment. That's fraud in either case.
We have one question that came in online. In terms of reps and warranty insurance claims, how does the process go once you have a claim? Are the insurers paying full value of your claim or not?
Yeah, so we touched on that a little bit. I think the process is very similar to any other claim you make under any insurance policy, which is the insurer doesn't want to pay it. I think, as I mentioned, we're not seeing, usually a breach is a breach, and it's pretty clear that there's a breach. And in claims we've made, we've always had insurers, you know, ask a little bit where you can tell the angle they're taking was there really a breach here? But usually, you know, we don't get to the point of submitting a claim until we know there has been. So that's usually not a very contentious point. Where it gets more contentious is on quantifying the damages and proving the damages. And as the buyer, you take a very simple approach, which is to say, here's the revenue lost from the contract that was breached, or here's the cost to the company that they didn't reflect. Here's the multiple that we paid and how we based our purchase price. And you just multiply A by B, and those are the damages, which tends to lead to a higher number than what the insurance company predictably thinks are the damages. And they'll look at more, you know, again, mitigating factors and what else could you have known and how would this have affected your analysis, and should you have known things from your diligence. And it's basically the insurance company positions itself with arguments of varying degrees of impressiveness as to why the damages should be lower. So in the one sort of really big one that I was involved, we said there was a breach of a contract. We took the revenue loss due to the breach, applied the multiple. The number we came up with was 23 million. The insurance company came back and said, well, in your diligence, you should have known the revenue wouldn't have been as high as you thought. The number they came back with was 8 million. So very big delta. We fought over it for 3 months and ended up agreeing on something like 12 million. But more, I think in a lot of cases, it's just that the breaches of those size could lead to cash flow issues for the company. And I think the owners just want to settle quickly and get cash in the company rather than fight for 2 years and maybe get a little more. So I think you're seeing that the insurance companies have some leverage there in terms of getting a settlement. But I find where the arguments will be on claims is going to be on the damages rather than whether there's a breach. And you'll get paid eventually, just probably not as much as you had hoped, unless it's really a clear-cut case where damages are, very obvious and clearly defined.